When talking about investing in the stock market, everyone wished they had a crystal ball telling them what the future was going to look like. If someone gave you a free ride in a time machine, wouldn't you go back 15 years and tell your younger self to invest all the money in Amazon, Google, and Apple? Unfortunately, the crystal ball doesn't exist. However, the next best thing would be to be able to spot trends in specific industries, make changes to your portfolio, and not being fixated on companies' past performance. In today's video, I'll give you 3 excellent examples of these trends and how you can take advantage of them as long as you are investing in the long term. Hi, my name is Darius Muica. I'm a senior investment advisor with Noor Private Wealth. If you are new to my channel, I focus on helping clients build wealth in the most tax-efficient way possible. So let's jump right in. Back in 2017, I made the decision to reduce exposure to oil companies. Close to 70% of oil consumption is used in transportation. Out of that, most of the oil is used by cars and trucks. At the time, talking about electric cars sounded far-fetched and was often met with skepticism by clients. There was no infrastructure present and no car manufacturers had a fully electric car other than Tesla. I had to make a parallel to the beginning of the last century when the automobile was invented. It was met with the same skepticism back then, and in the picture on the left is one of the first few cars driving in New York Times Square. And it's obviously surrounded by horse-drawn carriages. Back then also, many were wondering why they would ever choose a car when the horse was so much more reliable. Well, 15 years later, in the picture on the right, we can see one horse-drawn carriage and it's all surrounded by cars. 4 years ago, the Energy Industry Administration and other forecasting agencies estimated that electric vehicle sales would total a few 100,000 units in the early 2020s. After electric vehicle sales hit 1.45 million units in 2018 and an estimated 2 million in 2019, the same agencies now forecast roughly 6.5 million in 2024. The world is changing faster than ever before. If it took the radio 38 years to reach 50 million users, well, Facebook did it in 1 year and Pokemon Go did it in 1 week. The average lifespan of companies is dropping. The companies that don't adapt will be replaced. Investing in companies that have been around long before we were born and thinking they will be around long after we're gone is no longer relevant. In a white paper, the ARC research team identifies 5 industries that could be disrupted by innovation. The first industry is transportation. Autonomous electric technology will cause a tidal wave of disruption not only in the auto industry, but in many other industries. If battery systems costs decline, we believe electric vehicle prices will follow, triggering mass market adoption. At the same time, autonomous driving systems could boost the utilization and lower the cost of transportation dramatically. According to ARC's research, robotaxis could cost consumers just 25 cents per mile, less than half the cost of driving a personal car, half the cost of a short flight, and at a cost close to many public transit modes. As a result, autonomous taxis could become the dominant form of personal transportation in urban areas, reducing the need for many consumers to purchase personal vehicles. According to estimates, US auto sales will fall nearly 50% from 17 million units today to just 10 million during the next 10 years. Because autonomous taxis will be 8 times cheaper, companies like Uber and Lyft will not be competitive and would be forced to partner with companies like Tesla and Google in order for them to stay relevant. This would reduce their profit margin from 30% to less than 5%, making them just minor participants in the mobility market. So if you were wondering this year why Tesla had a higher valuation than Toyota, this could be part of the reason. I mean, if we're to look at the numbers, from 2012 to 2019, Tesla sold 891,000 cars. Meanwhile, Toyota sold just in 2019 10.7 million cars. However, Toyota is facing a massive challenge in research and development to catch up to Tesla's electric vehicle technology. Traditional automakers and their networks are in grave danger. The transition to autonomous electric platforms could create a winner-takes-most industry thanks to the massive amounts of data necessary to create autonomous driving platforms. Think about it this way. Every Tesla vehicle on the road is collecting driving information that is being sent to and processed by an artificial intelligence program to improve autonomous driving. Once complete, few companies will be able to compete with Tesla's autonomous driving program. As a result, the industry is likely to consolidate, with the survivors being those with successful autonomous technology and electric vehicle platforms. Auto insurance companies will also be affected. With autonomous driving safer than human-driven vehicles, accident rates could drop by more than 80%, and this would drive insurance costs lower. The second industry is physical bank branches. In Canada, commercial banking is the largest industry with a revenue of $240 billion for 2020. In the US, financial and insurance companies account for 10% of the market capitalization. The Federal Deposit Insurance Corporation reported a drop in the use of bank branches and an increase in digital and mobile banking. So far, it seems that digital-only businesses such as Square's Cash App, PayPal's Venmo, Chime, and other digital wallets are benefiting more than banks from this change. While banks like Wells Fargo, JP Morgan, and Bank of America report an increase of digital channel users, they do not disclose the extent to which digital is contributing to incremental customer acquisition. Wells Fargo, for example, has disclosed that its digital active user base increased by 4 million during the last 4 years, but the net new checking account customers rose only 800,000. Over the same time period, digital bank Chime increased its checking account users by 5.5 million, while the number of monthly active users shot up by 32 million on Venmo and 30 million on Cash App. Square also announced that active Cash Card users increased by 7 million during the same time period. It is very likely that digital wallet users could become more valuable than Wells Fargo's checking account customers during the next 3 to 5 years. A traditional bank pays on average $1,000 to acquire a new customer. The cost for digital-only banks is only $20 thanks to savvy marketing strategies, viral peer-to-peer usage, and significantly lower cost structures. The third industry we'll look at today is brick-and-mortar retail. In-store retail sales peaked back in 2015, and this year the pandemic has accelerated the shift to e-commerce. We have seen a jump in e-commerce in US from 11.3% of retail sales at the end of 2019 to 16.1% in the second quarter of 2020, and this is expected to increase to 60% by 2030. With retail sales per square foot dropping over the years, as we can see on the left chart, and surprisingly the retail square feet per capita shown to be increasing on the right chart, and with e-commerce growing at an accelerated pace, this means that we can expect more bankruptcies over the next decade, especially across retail categories with heavy real estate footprint. This will also affect real estate investment trusts that have high exposure to retail, and they will see their underlying assets become less valuable and they will have to be repurposed. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.